listening to the Daily Gold Podcast, covering precious metals, the junior mining sector, and global capital markets for intelligent investors. Now, here is your host, Jordan Roy-Byrne.
Hey, everybody. Welcome back to the Daily Gold Podcast. I have a new guest with me today. I've interviewed him on one of my other podcasts, but this will be the first time on the Daily Gold Podcast. He is Robert Sinn, also known as CEO Technician and Goldfinger. I like to call him Goldie. So I apologize if that disturbs anyone in advance. But Goldie, we were talking offhand, and by the way, Goldie's also the publisher of Energy and Gold.com. So definitely check that out. Goldie, we were talking beforehand about the things that we should cover, and you made a really interesting point in different words than I made. I made this similar point in my premium update this weekend, but I liked how you framed it, and I want to see if you can delve more into that, because the point that you made is, the Fed, there's this talk about higher for longer, which has been the case. I mean, that has been the case so far. There's some talk there could be several more rate hikes. Recession is looming, but it's not imminent. You have strength in the stock market now. Dollar has turned up. Bond yields are moving up again. And yet gold is still, it's, 1960, 1965. It's not that far away from a new all-time high. So I just want to get your color on what you think is driving all that.
Well, Jordan, thanks for inviting me to speak with you today. And I like the Goldie, nickname. I think it adds a little flavor, and it's kind of funny. So gold is a bit of a conundrum now. Let's go back like 6 months to like November of 2022. Gold was floundering around 1700, 1750. A lot of the guys I was speaking to were bearish. They're like, the Fed's gonna have to keep hiking. The Fed's gonna stay tight. This is really bad for gold. We're gonna get positive real interest rates. People were really bearish, and I don't think many people had much exposure to gold. I'm pretty sure that hedge fund exposure was pretty low at the end of last year. And then something happened as 2022 wound to a close, and January started. Gold really, it basically moved from 1800 to 1975 almost in a straight line in January. And, today we're right around 1975 still. So even though it's not over 2000, the gold price is pretty firm, and we're about 5%, as you said, from a new all-time high price. So Fed funds rate is 5.25%. A lot of market commentators think the Fed's going to hike interest rates again in 9 days. They might even hike twice more, this year. We might even get up to 5.75%. A lot of people are saying no rate cuts in 2023. The Fed itself is saying no rate cuts in 2023. So add all that up, that's not exactly a bullish fundamental backdrop for gold, right? So what is going on here? Like, what is driving gold? Okay, I know in March we had a regional banking crisis, and the Fed had to expand its balance sheet again to save some of these banks here in the U.S. Okay, that was bullish for gold, no doubt about it. But it appears like the banking crisis is over, or at least we have a relative calm that has set in recent weeks. So what is really going on? And it seems to me that, well, you have the whole de-dollarization thing. Okay, China is accumulating gold. That's obviously very positive and a big fundamental support to the gold price. So obviously that is in play, no doubt about it. But I feel like there's something even more going on, and that is the market is looking around the corner into 2024. So, we know the Fed could probably hike again. We know, just based upon the Fed funds market, that if there is a rate cut this year, it's probably going to happen later in the year. So that's already all priced in. Like all this Fed tightening is already factored into the market. But what about 6 to 9 months from now? What's going to happen then? And I think gold's relative firmness, in the face of a lot of things that would be otherwise quite bearish for the gold price, has to do with what's around that corner. And what's around that corner could be a pretty aggressive rate cutting cycle starting in 2024. And who knows what other extraordinary measures the Fed might be forced to take 6 to 9 months from now to support the economy. And I don't have all the answers to that, but I do feel like there's going to be some sort of yield curve support and treasury buyback, something to help fund the US government is coming around the corner. When you just look at the deficits that are being run, the amount of debt that has to be issued by the Treasury in the next year, the fact that next year is an election year, it's a presidential, election year, so there's going to be a lot of giveaways and pandering going on. So you put it all together, I feel like gold is looking ahead to next year.
Yeah, that's really interesting. I mean, quick follow up on that. Do you know when the next rate cut, or not the next one, I should say the first rate cut is priced in? Because I remember around maybe it was a month ago or so, or when the regional banking crisis started, I feel like the first cut was priced in I don't know, July maybe, if there's a Fed meeting in July.
So no, it's moved back to November now. So the
Right.
Fed funds futures market is basically saying that there's a 70% chance that the Fed funds rate will be lower than it is today in November. So 5 months from now, that's pricing in a quarter point cut.
Well, but even though that first cut went, it went back by 4 months, gold hasn't declined that much. I mean, I'm making it really simple. We could say, okay, that's the reason why gold didn't break out. The latest breakout attempt failed. The rate cuts are getting pushed back, but even getting pushed back by 4 months, there hasn't been that much damage done to gold, in my opinion. I mean, there is some technical damage in the chart, of course, but I guess that speaks to what you're saying. The market is looking ahead. Is there anything that you think could happen in the coming months, like before the market realizes that, okay, that's it, and they immediately have to start cutting? I mean, I guess if the bank stuff flares up again, that would be the obvious answer. I'm just trying to get a sense of, if there's a
Well,
I mean,
yeah,
obviously, when the market knows the Fed has to cut, that's a catalyst. I'm just trying to think of, like, could there be one or two dominoes before that everybody should look for?
well, it's interesting. A lot of gold moves are forex moves essentially. They're like the second order of what yields and the dollar are doing, and it's all sort of one big trade going on. So one thing that comes to mind is the Fed probably doesn't want the dollar to be very strong, or certainly not much stronger than you know it is right now. So there's some thought that China is having some real problems with its economy and its reopening, and they might reduce the value of the yuan, right? So if they lower the yuan against the dollar by what, I don't know, 2%, 3%, 4%. I'm not sure by what magnitude they would do that, but they certainly can. The Chinese government, um, Central Bank of China, can absolutely do that. They've done it previously. Then what might the Fed want to do? They don't want the dollar to get too strong because it tends to be a bit of a wrecking ball for markets and the economy when it gains um, a lot of strength, right? Like, think back to like last September, October, euro dollar was that it broke through par, got down to like 96 cents. And obviously, stocks and the economy weren't doing fantastic at that point in time. And there was a lot of worry. And since then, obviously, we've gone from 96 cents to a dollar, dollar seven, dollar eight. And that's coincided with markets doing great, stocks rallying, and the economy being stronger than many people had forecasted to be. So that's one thing that comes to mind. But the thing is that we can never forecast the next crisis. We might have a list of like 5 or 6 things that could go wrong, and we're like keeping an eye on them. But it's always something unexpected. It's always something out of left field. I don't know anybody who at the beginning of the year was saying there's going to be 4, regional bank failures in the U.S. and the Fed's going to have to backstop the, regional banking, system in the U.S. I didn't see anybody, forecasting that. So who knows what the crisis could be or what causes the Fed to make a pretty strong pivot. But we just know that at 5.25% on the Fed funds rate, after 500 basis points of rate hikes in less than 2 years, that in some ways the Fed is now a coiled spring in terms of easing, in terms of potential easing. The thing is that we're not there yet. We're not at the pivot yet, and we might not be at the pivot for another 4 to 6 months, just because the Fed has to make sure that the trend in inflation is clearly down and that they're probably under 3% on CPI before they actually make that first cut.
Right. But it's, I mean, not to say everything is bullish for gold, but part of what you were saying about the dollar getting too strong, it's almost like if the dollar gets too strong and if the Fed even hikes a couple more times, it's like counterintuitive, but that's more bullish for gold because that is going to do more damage to the economy and potential financial
and
system,
you
which
get
means,
that.
which means
I
more,
love
which
that you
means,
get that. A lot of people don't seem to get that. And you just nailed it. That's absolutely true. Yeah. So the Fed does more damage, Fed funds goes higher. And so, yeah, and maybe that is really negative for markets and even for gold in the near term, but longer term, it's just that much more bullish.
I think gold. I think gold would. I mean, because the market is smart enough to know. Okay, if the Fed does, let's say, 2 more rate hikes, the market is smart enough to know, like, they've already been hiking a really long time. 2 more hikes, they're going to be, done really soon anyway, and they're going to have to basically take those back when they start cutting. Therefore, this sell off in gold you might sell off for like, might go down $50 in a week or something like that, or $75. But yeah, I don't think that stuff would stick. But then the tricky part is, I mean, you and I know, because we briefly talked about this, the technical damage. And I mean, you can't read everything into the charts, but monthly candles are not good. The weekly candles are pretty ugly. And so it's, I mean, at least if you're going to be really bullish, it speaks to what you're saying, that it will take a little bit of time, for the catalyst to come, and for, the market to find a equilibrium, gold market to find an equilibrium before it can begin that next leg higher.
Yeah, I think that's a great point, and I agree with you. In fact, one of the things I said this weekend in a video I did was, I don't think the month of June is going to be great for gold. I think maybe best case we tread water around 1970, 1980 area. Maybe we probably trade in a range, maybe down as low as 1920, maybe as high as 2000 or 2010, but in a range that's going to frustrate a lot of people. And in the near term, the technicals do not look great, right? But in my very next breath, a month from now or 6 weeks from now, the technicals could look a lot better, right? It just needs time to sort of work itself out here and sort of form, a new bottom, like a new low. I'm not convinced that 1936 is our new low. Probably need to test a little lower, sort of wash out the sentiment just that much more. But I'm also not convinced that gold has to go under 1900 on this down move. I think that we could hold somewhere around the previous all-time high, which is 1923 from 2011, somewhere in that area, build a base again, and then maybe 4 to 6 weeks from now, start to really move back up again. And that's the really important thing about technical analysis is that patterns are always morphing, charts are always changing. And as a good technician, we have to change our interpretations and we have to take in the new information. And that's really important. There's always new information coming. And we have to be clear on our time frame. So when I say near term, I might be bearish on gold for the next 2 weeks or 3 weeks. But 2 to 3 months from now, I think gold will probably be a lot higher.
Yeah. Yeah, I was thinking the thing about technical analysis is it always looks like it's perfect in hindsight. Well, of course it was going to bottom at the 200-day moving average. And, then it was going to, I called the gold breakout right here. And it's like, well, yeah, you called, it's the joke. Like, yeah, Peter Schiff has called like 0 of the last, 35 bear markets in the dollar, whatever. But, and just, yeah, a quick point on that. Yeah. Cause I see huge, significant, just massive support in the mid 1800s. That's slowly, building up. It could, 3 months from now, it could be at 1860 or 1870. But I mean, you could be right about it not going down that far. I mean, that would be a really bullish signal. If it wouldn't come all the way down. I mean, I look at it corrections. I tend to be like too conservative or not bearish enough. So I don't know. I'm just saying this could be one instance where I'm looking at 1850, but maybe it comes down to 1880 intraday or whatever. But that aside, you mentioned sentiment. That's something I want to get into. It's really interesting because when a market, like when you're starting a new bull market, you actually need bullish sentiment because you need an influx of new people to adopt that trend and become buyers, consistent buyers over time. And that's why you see, every time gold breaks out, like pretty soon after it breaks out, the COT looks terrible, like a week or two after it breaks out. I mean, that was true in the 2000s. But, you look at open interest on the COTs. I just noticed that this weekend for silver and gold, like they're really low, like they're close to multi-year lows. We look, I just posted a video. I mean, Kitco News, they're not even covering gold anymore. I mean, just look at the last 16 videos. One of them is about gold. I mean, thank God for Rick Rule, because if not for that, they'd have no gold video. They're talking about crypto. I'm sorry, I want to go on a tangent, Goldie, but I mean, Bitcoin is like 65% below the new all-time high, or the old all-time high. It went up for 10 years, and they're still talking about, they're a gold website, and that's just the focus. So I mean, is Kitco and the fact that the largest gold publisher is not really covering gold? And look, this was true. I went and I looked at even a month ago when gold was much hotter in a short-term sense. Like less than half the videos were about gold. They weren't even talking about it that much. So is this an indication? I don't know. Well, I guess I should say, what is this an indication of?
What is this an indication? Well, it's interesting. I'm glad you go to Kitco because I barely go there anymore. So maybe that's also a sign, the fact that I have very little interest in Kitco. And 10 years ago, it was like one of my favorite sites to check, So it's somehow it's lost its relevance in some way, shape, or form. And yeah, they like Bitcoin a lot, which is fine. I got nothing against Bitcoin, but that is a little weird. And I'm trying to think why that is. And it must be that people are just more interested in Bitcoin. There's more people that want to see those videos than want to see gold videos or gold market analysis. So that is very interesting from a sentiment and contrarian perspective, because I'm pretty sure that Kitco is a business and their model is advertising revenue, so they must be able to sell more advertising on stuff about Bitcoin than they do for gold. As far as sentiment goes, well, right now it's not great. So let's just talk about gold. I'm not talking about mining stocks here. I want to be clear. Just gold and silver, so the metals. Um, I don't think sentiment is super washed out bearish, but I don't think it's bullish either. I think we're somewhere in the middle. And I'll say that in March, when gold was having that very nice run up from about 1825 to over 2000 in a matter of like 3 or 4 weeks, I think we did, like you were saying in your last paragraph there, that the bull market rises as new people come into the market, new people buy and become, bulls on said asset or stock, right? So in terms of gold, there are new gold investors that started to come in, I think, at the end of March and early April, based upon, we've got a banking crisis, Fed has to bail it out, de-dollarization, China, Russia, South Africa, et cetera, these countries are all going to stop using the dollar, right? So there was a certain number of investors that were converted to being gold bulls during that little, you know, in relative terms, it was a little move, a fairly small market move. However, I wouldn't say that was a bearish sign that those new investors came in. I feel that was one of the early legs of a new bull market move. So we just had the first new adopters come on board. The market consolidates. So what it's been doing and what it might do for the next couple of months, it's going to consolidate. Sentiment is not going to be bullish. Sentiment might get bearish at some point, but most likely it's just going to stay sort of in the middle, sort of where we are now. And then the market will have its next leg. And if we use the, wave theory that there's going to be three legs higher, three waves higher during the bull market, I think we maybe just had the first wave. So we're waiting for that second wave, and then there will be even a third wave down the road. So we're just in between, this is my opinion, this is my analysis. I think we're in between the first wave and the third wave right now. We're just marking time and consolidating. And then this next leg higher is going to be one to new all-time highs. And it's going to bring in a lot of new investors into the gold market.
Yeah, great points. Let's move and talk about the stock market and also the economy. Obviously, this influences gold and precious metals. We got this little breakout, the S&P 500. I'm just seeing generalist technicians. They're getting super excited. All these great new buy signals, new bull market, completely ignoring the yield curve, which is basically, almost like the holy grail of recession indicators. What do you make of what's going on here with respect to, you got this little breakout in the stock market, and you have all this data pointing to not an imminent recession, but a recession, and yet the stock market has broken out. And at the same time, sentiment on the stock market or positioning, people have not been positioning for upside. So at least for me, what do you make of all these conflicting factors?
Jordan, I think it's a triumph for us as technical analysts because I know we both do fundamentals too, but at the end of the day, I prefer charts, and I know you do too. If you put a gun to my head and you said you can only look at one thing, I'd say just show me the chart. And I think that you feel the same way. So it's a triumph for technical analysis and breakouts and trend following. Just take a look at the QQQ chart. So I agree with you. The economy is not great. I don't really get the fundamental bull case for stocks here, aside from a lot of people are bearish and there's a lot of cash on the sidelines, but that's not really a great thesis. Cash on the sidelines. How many times have we heard cash on the sidelines? Right? Yeah, there's a lot of cash on the sidelines.
I think we heard that back in the Stone Age.
Yeah, exactly. But Just look at the chart, stupid. It's going up. The QQQ. I mean, it's classic bull market stuff. It bottomed in October, made a higher low at the very end of 2022, the last week of the year. It made a higher low. And then in January, it thrusted higher on its first big impulse, had a normal pullback in February and early March, and now it's just rocketing, And hey, this is not me recommending anybody buy the QQQ or tech stocks. I'm just pointing out what's happened, it's had a big move, and fundamentals be damned. I mean, I guess Nvidia had great earnings. I guess Microsoft beat earnings. I guess Apple beat earnings. All these companies are making tons of cash in this recession, soft landing, who knows what it is economy. Big tech is where it's at. And there's no point in trying to overanalyze the quote unquote fundamentals. Just look at the chart, man.
Yeah, fair enough. It's hard to disagree with that. But as a follow up to that, would you be worried about the fact that all this money is crowding into, the S&P 10? I mean, if you look at I think the S&P 10 are up 32% on the year. The S&P 490 are up 0% basically. And you look at, you see some charts that show, I don't know exactly what the date, the difference between the leaders in the market and like everything else. You see points come up like 2008, 2000, even to 2020 before COVID. That to me is that's not good if you're looking for a new bull market here. So for me, I mean, I'm just putting out my opinion. I am trying to figure out, we know we have this looming recession. It's not imminent in my opinion. Maybe it hits in the third quarter, end of the third quarter, or maybe it hits even in the fourth quarter. I know some people are saying Q1 next year. So you have that. And yet at the same time, you have the market's going up, but you have all these warnings about, how narrow the performance is. It speaks to like the end of a bull run, basically. Then at the same time, not a lot of, positioning has been so offsides for this move. I guess I'm just trying to figure out, I mean, how much longer can this move in the stock market go? Can it go? Because I know really smart people are thinking there's no way this can go on for more than like another month or two. But then at the same time, if the recession is not going to be here till Q1, and historically, the market doesn't really peter out until a month or two before the recession, you could have, and people are underinvested, you could have this go on for, 4 or 5 months. So, I mean, I know there's not a question in there, but that's, I guess that's kind of how I'm thinking about it.
The question is basically, can this continue?
Yeah. Question is, tell me when the peak is going to be at. That's the question. Tell me when it's going to top, Goldie.
I've learned that I cannot forecast how long a bull market's going to last and when it's going to end. So the only thing that I can see is a lot of people are skeptical. A lot of people are saying narrow breadth. I agree. The breadth of the market rally in the last couple of months has been relatively narrow. I agree. However, bull market can undergo rotation during various stages of the bull market cycle. And like last Friday, we started to see some rotation. We saw big moves in oil stocks. We saw home builders rally. We saw copper miners like Freeport-McMoRan rally, even though copper is only at $3.70 a pound, right? So I know today market had a little bit of consolidation pullback, but look, this bull market can continue. And the fact is that if you had asked me like last October, what's the one sector you want to make sure you don't want to be a part of or you want to be short of in the market, I would have said home builders, right? And that would have absolutely bottom ticked the home building sector. I would have, of course, I didn't short it, but I would have told you that would be the one sector I would never want to own in this next year. And I would have been 100% exactly wrong. Last October was the low, or was a low, for the home builders. And home builders are near 52-week highs. They're lower left to upper right on the daily chart. So my fundamental understanding, quote unquote, or lack of understanding of how the economy and the home building and real estate sectors works would have said Fed rate hikes, a tight Fed, higher interest rates are bad for real estate and new home construction. But that's a very shallow analysis, and clearly it's a wrong analysis. And the home builders have actually exceeded expectations in the last several quarters, and they're doing well. So home builders making new 52-week highs, not exactly characteristic of a bear market, in my opinion.
Right. So we've covered a lot here today, Goldie.
Yeah.
Before we wrap up, is there anything that I didn't ask you about that you think is worth mentioning?
You know, a lot of people want market forecasts. A lot of people want to know when gold is going to do this, when silver is going to do that. You know, like my simplest thought is gold is going to be a lot higher from where it is today, a couple of years from now, 5 years from now, 10 years from now. And there's no point in agonizing too much over the squiggles on the chart. You know, just try to get the big inflection points reasonably right. And most importantly, try to ride the trends as best you can. And don't get too caught up, unless you're a day trader, you know, trading 3-minute or 5-minute charts. If you're an investor, just try to focus on the big picture trends. And one trend that I'm very confident of is that gold is in a secular bull market uptrend, lower left to upper right. Don't overthink it.
All righty. I love it. On that note, Goldie, before I let you go, please tell our listeners where they can go and how they can follow you and your work.
Yeah, thank you. Add Goldfinger Capital on YouTube. So I'm over 500 subscribers. I've just started to be active on YouTube in the last 6 months. So please subscribe there. At Goldfinger on CEO.ca, at CEO Technician on Twitter. And if you follow me on those 3 places, you pretty much get the best stuff that I got. So thanks a lot for your time, Jordan.
Hey, Goldie, it's a pleasure to have you on. Thank you so much for coming and talking to me. And I'll have to have you back soon so we can dissect what's going on in all these markets.
All right. Sounds good.
Thank you for tuning into the Daily Gold Podcast. For more interviews, editorials, and analysis, log on to TheDailyGold.com. And for premium coverage of precious metals and the best junior mining companies, visit TheDailyGold.com/premium.